Meet Tyler. Tyler is 24, makes $52,000 a year, and has the financial discipline of a golden retriever in a butcher shop. Last November, Tyler bought a $280 jacket using Klarna, then a $190 pair of sneakers on Afterpay, then a $120 skincare bundle through Affirm, then, and this is the part I need you to sit with, Tyler used Buy Now, Pay Later to pay for Chipotle. This is not a joke. 22% of Buy Now, Pay Later users used the service to pay for food delivery in 2025. Not a MacBook, not a couch. Food delivery. The burrito couldn't wait 2 weeks. And Tyler isn't alone, because there are currently 86 million Americans using Buy Now, Pay Later services. That's roughly 1 in 4 adults in the United States who have looked at a checkout screen and decided that paying for something in 4 installments was better than just paying for it. And the industry that makes this possible is now valued at $560 billion globally and growing at nearly 14% per year. And none of that would bother me if the product were what it claims to be, because the pitch is genuinely elegant. No interest, no credit check. Split your purchase into 4 easy payments. 0 fees if you pay on time. It sounds like a favor. It sounds like a financial tool designed by someone who actually wants to help you. It is not that. And by the end of this video, I'm going to show you exactly how Buy Now, Pay Later is the spiritual successor to the payday loan industry, just rebranded for people who use TikTok and shop on their phones. Same mechanics, same trap. Better user interface. Let's start with the part nobody talks about at checkout. Because if you want to understand what Buy Now, Pay Later actually is, you have to understand what it isn't. It isn't a payment plan, it isn't a budgeting tool, and it definitely isn't free. What it is structurally is a short-term loan. You are borrowing money from a fintech company to pay a retailer and then repaying that fintech company in installments. That's a loan. And like every loan in history, the company offering it is not doing it out of generosity. So how does Klarna make money if there's no interest? Great question. Because that's the part of the sales pitch that sounds too good to be true, and which, as always in finance, is too good to be true. Here's how the business model actually works. When you use Klarna or Afterpay at checkout, the retailer pays a transaction fee of roughly 2 to 8% of the purchase to the BNPL provider. In exchange, the BNPL company takes on the credit risk, and the retailer gets their full payment immediately. So the retailer is essentially paying a premium to have a frictionless checkout experience that increases their conversion rates. And the BNPL company collects fees from millions of merchants across every category imaginable: clothing, electronics, travel, furniture, and apparently burritos. But here's where it gets interesting. Because merchant fees alone don't fully explain the business model, the second revenue stream is the one they put in the fine print: late fees. And in a world where 29% of BNPL users have made a late payment, including 39% of Gen Z users and 35% of millennials, that fine print becomes a very reliable income statement. Which brings us to the moment this stops being a clever checkout feature and starts being a structural problem. Because Buy Now, Pay Later was supposed to be the safer alternative to credit cards. No interest, no revolving debt, no 27% APR, slowly eating your savings from the inside. And on paper, for one transaction, it is. But here's the thing about what happens at scale, with real humans, in the real world. The CFPB published a study in January 2025, and buried inside it was a number that should make your stomach drop. 66% of BNPL users are carrying multiple BNPL loans at the same time, not one. Multiple. And 33% are borrowing from more than one BNPL lender simultaneously, meaning they have active installment plans open with Klarna and Afterpay and Affirm at the same time on different purchases, all auto-debiting from the same bank account. On different 2-week cycles, they are almost certainly not tracking. Because only 47% of BNPL users say they plan their payments ahead of time. The other 53% are either tracking loosely or not tracking at all. Gen Z is the least likely to plan at 38%, which means a majority of the youngest, most financially inexperienced users of this product are going into debt on a schedule they're not following. Because here's the comparison the industry does not want you making: payday loans. Payday lenders have been called predatory for decades. They target people in short-term cash crunches, offer immediate access to small amounts of money, and charge fees that translate into annualized interest rates that would make a loan shark blush. And the entire regulatory apparatus of the United States government has spent years trying to rein them in. Now, let's look at BNPL, short-term access to credit. Targets people who can or won't use traditional credit. Fees that only apply when you slip up. Primarily used by younger, lower-income, financially stretched consumers. The difference is the aesthetic. Payday lending happens in a strip mall next to a check-cashing place with a neon sign that says Fast Cash. Buy now. Pay later happens on a clean white checkout screen next to a rose gold font that says 4 interest-free payments of $34.75. One of these products screams debt from a mile away. The other one looks like a feature. And that's the innovation, not the technology, not the split payments. The rebranding of debt as convenience. Let that sink in. Because here's the part that moves this from annoying into genuinely alarming. BNPL debt, in most cases, is invisible. It doesn't show up on your credit report. And while that might sound like a benefit, it creates a problem that nobody in the industry likes to talk about. It's called phantom debt. Because when you apply for a car loan, a mortgage, or even a new credit card, the bank runs your credit report to see how much you owe. And your credit report will tell them about your credit cards, your student loans, your auto loan, and your medical debt. What it will not tell them, in most cases, is that you currently have 7 open BNPL plans, auto-debiting from your checking account every 2 weeks. Meaning, lenders are making credit decisions on an incomplete picture of your financial life. They think they're lending to someone with manageable debt. They're actually lending to someone whose checking account is a minefield of scheduled withdrawals they may or may not be tracking, and you're the one standing in the minefield. This is why financial analysts started using the phrase phantom debt. Because BNPL balances are real, they're active, they're collecting interest in the form of late fees when payments fail, but they are largely invisible to the traditional credit system. And as the CFPB noted, this creates a masking force, a way for consumers to appear more creditworthy than they actually are, right up until the point where they aren't. And if you want to understand where this ends up, you don't need a PhD in economics. You just need to look at one data point. BNPL users, on average, carry $871 more in credit card debt and $453 more in personal loan debt than people who don't use BNPL. That's not a correlation that suggests BNPL is helping people manage money better. That's the profile of someone who has run out of room on every other credit product and is now adding another layer on top. Which brings us to the uncomfortable truth that the industry has spent $2.81 billion in Klarna revenue trying to obscure. Buy now, pay later doesn't create purchasing power. It borrows it from your future self. And the marketing is specifically designed to make your future self feel like a problem for later. Because the psychology here is not accidental, it's engineered. When a $280 jacket becomes 4 payments of $70, the brain doesn't process it as a $280 purchase. It processes it as a $70 decision. There's decades of behavioral economics research on this exact phenomenon. Smaller payment sizes reduce the perceived cost of a purchase. And BNPL is, at its core, a product built entirely around exploiting that cognitive gap between what you're actually spending and what it feels like you're spending. When you buy something on a credit card, you see a total, one number. It might hurt a little. You might hesitate. BNPL removes the hesitation. It takes the one number and divides it by 4. And suddenly, your brain approves a purchase it would have reconsidered 6 seconds earlier. The checkout conversion rate goes up for the retailer. The BNPL company earns its merchant fee. And you go home with a jacket your budget didn't actually have room for, broken into a payment schedule you'll track loosely at best. And the list just keeps growing. Because it's not just jackets and sneakers anymore, people are using BNPL for groceries, for medical bills, for rent in some markets, for food delivery. When the product designed to make discretionary spending feel more manageable starts showing up in the category of things you need to survive, that's not a budgeting tool anymore. That's a symptom of something much bigger. That's people using debt products to fill the gap between what they earn and what everything costs. A gap that has been widening for years and is now being papered over by a Swedish fintech company with good branding. Which brings us to where this is all heading. Because Klarna went public in 2025 at a $19.65 billion valuation. Affirm is publicly traded. Afterpay was acquired by Block, formerly Square, for $29 billion. These are not small experiments in payments technology anymore. They are major publicly traded financial companies whose business model is fundamentally dependent on consumer debt volume. Meaning, the pressure to grow isn't coming from some startup founder who just wants to disrupt checkout. It's coming from shareholders who want to see gross merchandise volume go up every quarter. And the way you grow gross merchandise volume in BNPL is not by helping people spend more responsibly. It's by being at more checkouts, in more categories, available to more consumers, with frictionless onboarding and a checkout experience so smooth that Tyler doesn't even register. He's taking out a loan while he's paying for his burrito. Now. Does this mean everyone who uses BNPL is destined for financial ruin? No. For someone who uses one plan at a time, tracks their payments, and never misses a due date, the product is genuinely useful. Zero-interest short-term credit for a planned purchase is a real benefit. That version of BNPL exists and is totally fine. But that's not the version the numbers are describing. The numbers are describing 66% of users carrying multiple simultaneous plans, 39% of Gen Z missing payments, a user base that carries significantly more total debt than people who don't use the product at all, 26% of users who regret using it once the full cost hits home, and an industry growing 14% a year into an economy where consumers are already stretched. Here's the 4 most dangerous words in retail finance right now. 4 easy payments of. Because they are not easy. They are timed, automated, recurring debt obligations that your brain agreed to in the 11 seconds it took to click through checkout. And the machine on the other side of that click has been specifically optimized to make sure you didn't stop to think about it. So before you split your next purchase into 4 installments, ask yourself one question. If you can't afford to pay for it today, what makes you confident you'll be able to afford to pay for it in 2 weeks? Drop your take in the comments. Do you think BNPL is a genuinely useful tool being misused, or is the product itself the problem? Because I think the data already answered that question, but I'm curious to hear if you disagree.